Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So now I'm going to start the main problems on capital and revenue expenditure. The last three videos I have prepared. The first video on the theory regarding the explanation of capital and revenue expenditure with examples, effect on income statement and statement of financial position. All these things I have explained. So if you want the complete perfection on this topic, I suggest you to watch the first theory video completely. Then only you come to the problems. Otherwise, if you join in between, you will not be able to get the much benefit from these videos. So before starting the main problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So always keep the problems ready. Take a screenshot of the solution of the first 7 problems I am going to discuss in this video. Then I'll explain. Come on, see the first problem. Complete the following table indicating with a tick whether each item is a capital expenditure or a revenue expenditure. Simply you have to decide. 4 items are given. Each item, whether the item is a capital expenditure or revenue expenditure, that you have to decide. The first one is cost of vehicle. The cost of vehicle is a non-current asset. Vehicle is a non-current asset. When a non-current asset is purchased, it is a capital expenditure. So put a mark in capital expenditure. Put a tick in capital expenditure. Secondly, number plate. Number plate will be, fixed only once at the time of buying the vehicle. It will not be frequently changed. So number plate is also a capital expenditure. So put a tick in capital expenditure. Next one is fuel. The fuel is a revenue expenditure because again and again we have to fill the fuel. We have to use the fuel. The fuel is a revenue expenditure. It's a recurring expenditure. So fuel is a revenue expenditure. Insurance. Insurance is also a revenue expenditure because normally insurance will be for 1 year. So insurance is a revenue expenditure. That's all. Simply it is asking you to put a tick regarding capital expenditure or revenue expenditure. So cost of vehicle, capital. Then number plate, capital expenditure. Fuel, revenue expenditure. Insurance, revenue expenditure. Next, second. Tamara has recently opened a news agent in Mumbai. She sells books and magazines as well as some stationery. She also sells food and drink. Can you categorize the following purchases for her as capital or revenue expenditure? Just like the previous problem, here Tamara, sole trader. She has opened a news agent in Mumbai and she is selling books, magazines, stationery and some food items, drinks, etc. For this business, what are the capital expenditure? What is the revenue? Remember, the capital and revenue expenditure are not watertight compartment. That means we cannot always decide this is capital, this is revenue. It may differ according to the nature of the business also. According to the nature of the business. Simple example, if a furniture dealer is there, for a furniture dealer, furniture are goods. So when furniture are purchased, it's a revenue expenditure. Same, if another business is there, that business is a cloth business. In the cloth business, some furniture are used. It's a capital expenditure. So same furniture in one business, it is a capital expenditure. The other business, it is a revenue expenditure. So it depends on the nature of the business. In our problem, Tamara is the sole trader. She is having news agency in Mumbai. And she is dealing in books, magazines, then stationery items, then food items and drinks. Now for her, purchase of books and magazines is a revenue expenditure because she is the dealer in books and magazines. She is buying books and selling books. She is buying the magazine, selling the magazine. So it's a revenue expenditure. Next, purchase of shop fittings. Shop fitting is a non-current asset. So it's a capital expenditure. So shop fitting, capital expenditure. Purchase of cash register. The cash register is also one of the asset. It is one of the asset. So it's a non-current asset. So capital expenditure. Then comes purchase of stationery. Stationery is a revenue expenditure because she is a dealer in stationery. She is buying the stationery and selling the stationery. So stationery is a revenue expenditure. Last one, purchase of refrigerator. The refrigerator is a non-current asset. Once it is purchased, but refrigerator will give the benefit for a long period of time. So refrigerator is a capital expenditure. So here capital expenditure. That's all. We have completed 2 problems. Now problem number 3. Dawson owns several hairdressing salons in Hanoi. He has recently purchased some equipment for his salons. However, he has not accounted for some of the purchases in his accounts. These include chairs costing $3,000, shampoo costing $200, mirror costing $500, hair dryers costing $300. His profit for the year is $10,800. His non-current assets are $72,345. Calculate the new profit for the year and calculate the new non-current assets. That's it. Here in this problem, already before taking into account some purchases, the proprietor Dawson has calculated the profit as 10,800 and non-current assets as 72,345. After calculating this profit and non-current assets, he has to record the items of assets he has purchased. Chair is an asset, non-current asset. So this chair will be added to non-current asset. Shampoo. The shampoo is a recurring expenditure because hairdressing salon frequently the owner has to purchase the shampoo. So shampoo is a revenue expenditure. Then mirror is a capital expenditure, non-current asset. We add to non-current. Hair dryer is also one of the machine equipment, non-current asset. So here chairs, mirror and hair dryers. These 3 are non-current assets and these 3 will be added to 72,345 to find out the new current assets. Now profit. The profit is given 10,800. From this profit, any revenue expenditure will be deducted. One revenue expenditure is there, shampoo, 200. So out of 10,800, 200 is the revenue expenditure that will be deducted. We'll get the correct profit. That's it. So here, new profit for the year. Profit for the year as given. As given profit $10,800 minus cost of shampoo. This is a revenue expenditure. So that's why deducting from profit. So 10,600 is the new profit after adjustment. Now new current assets. Current assets, non-current assets as given 72,345, that is given non-current assets 72,345. To this we add new non-current assets purchased. So non-current assets purchased are chairs $3,000, mirror $500, hair dryer $300. So new non-current assets are 76,145. That's it. So 3 problems completed. Now fourth problem. Fourth problem is, it is asking you explain the difference between capital expenditure and revenue expenditure. So many times I explained in the last video itself. The main difference between capital expenditure and revenue expenditure is capital expenditure is incurred to acquire a non-current asset or add to existing non-current assets. That is capital expenditure. Revenue expenditure are day-to-day expenses. That is the first difference. Second, capital expenditure are non-recurring expenditure, whereas revenue expenditure are recurring expenditure. The capital expenditure will give the benefit for a long period of time, whereas revenue expenditure will give for a short period of time. The capital expenditure will be taken to statement of financial position, whereas revenue expenditure should be taken in income statement. The capital expenditure will normally increase the profitability of the business. The revenue expenditure will not increase but will maintain the profitability of the business. Will maintain the profitability of the business. Now, capital expenditure is the expenditure incurred to purchase the non-current asset, whereas revenue expenditure are the expenditure in maintaining the non-current asset. Expenditure incurred in maintaining the non-current asset. So all these are the points I have explained here. Revenue expenditure is the amount spent on day-to-day running of a business, whereas capital expenditure is the amount spent on purchase or addition of non-current asset. First, the cost of revenue expenses is written off against profit in the year incurred. So whenever a revenue expenditure is incurred, it will be charged to the profit. That's why it will be taken in income statement. Whereas the capital expenditure item are purchased to generate profit for the business and it is not for resale. When capital expenditure is incurred, it is incurred to generate the profit, not for selling the asset. Next one, revenue expenditure is used up within 1 year and appears in the income statement. Whereas capital expenditure will be used for a number of years and it will be taken in the statement of financial position. That's it. Next, fifth problem. Complete the following table indicating with a tick whether the transaction represent capital expenditure, revenue expenditure or neither. So 3 items are given. We have to decide whether each item is a capital expenditure or revenue expenditure or neither. That means neither capital expenditure nor revenue expenditure. First one, installation of a new machinery. When we install a new machinery, it is a capital expenditure. So installation of new machinery, capital expenditure. Repairs to machinery, that is a revenue expenditure, recurring expenditure. So repairs to machinery is a revenue expenditure. Third one, receipt of bank loan to pay for machinery. Receipt of bank loan. A loan is taken from the bank to pay for the machinery. So this loan taken is a capital receipt. When we take a loan from bank, it is a capital receipt. It is neither capital expenditure nor revenue expenditure. So neither. That's it. Over. So fifth problem completed. Now sixth problem. See the sixth one. Assess the effect on a business of the incorrect treatment of capital expenditure and revenue expenditure. In the theory video, I have explained you that it is compulsory for the accountant to distinguish between capital expenditure and revenue expenditure. If there is incorrect treatment of capital or revenue expenditure, then definitely it will have an effect on the financial statements. The financial statements, income statement will not show the true profit. The statement of financial position will not represent the correct value of assets and liabilities. Assets and liability. That's why it is compulsory before preparing the financial statements. An accountant, a person must be sure about the difference between capital expenditure and revenue expenditure. Now it is asking you what are the consequences of making a wrong treatment in capital and revenue. The first one, the incorrect treatment of revenue expenditure would result in the net profit being either overstated or understated. The first effect, if a mistake is done in treating the capital as revenue or revenue as capital, then the net profit in the income statement may be overstated or may be understated. So first effect will be on profit. The profit will not be true. It may be over or it may be under. Second, the incorrect treatment of capital expenditure would result in the non-current section of the statement of financial position being overstated or understated. See, when we commit a mistake in capital expenditure and revenue expenditure, the second impact is it will affect the current asset section of the statement of financial position. In the statement of financial position, we have non-current. Sorry, I told you current, it is non-current. In the statement of financial position, we will have a section called non-current assets. Those non-current assets will not be true if we make a mistake in treatment of revenue and capital expenditure. The first effect on the profit may be overstated or profit may be understated. Second effect, the non-current assets will not be correct. in the statement of financial position. Then if, for example, a business enters the purchase of motor vehicle in the motor expenses account, and this would result in the net profit being understated. With the help of an example, I am going to explain you. A business purchased a motor vehicle. So instead of charging this to motor vehicle account, the accountant has charged to motor expenses account, treating capital expenditure as revenue expenditure. Then what is the impact? The profit will be understated. Because motor vehicle is purchased, it should be taken to non-current assets. But instead of taking to non-current assets, the accountant has taken to income statement. So that's why profit is understated. At the same time, the non-current assets section of the statement of financial position will also not show the true non-current assets. And the value of the motor vehicle in the statement of financial position being understated. That is the effect. By treating capital expenditure and revenue expenditure incorrectly, this would result in the financial statement not providing a true and fair view of the business. Ultimately, if there is a wrong treatment of capital expenditure to revenue or revenue to capital, the ultimate final effect will be the financial statements, that is income statement and statement of financial position, will not show the true and fair view of the financial transactions. That is ultimate effect. That's it. So in this case, I have explained you what is the effect due to wrong treatment of capital expenditure to revenue expenditure or revenue expenditure to capital expenditure. That's it. Now next problem is problem number 7. Complete the table below. Again, we have to put a tick mark whether it is a capital receipt or revenue receipt, capital expenditure or revenue expenditure. The 4 columns are there given in the problem. Using a tick to indicate how each item would be classified in the books of Javid, a sole trader. Javid is the sole trader. Now he has incurred a number of expenses. Now we have to decide which item is a capital expenditure and which item is a revenue expenditure by putting a tick mark. So here, capital receipt, the columns are capital receipt, revenue receipt, capital expenditure, revenue expenditure. Each one we have to decide. Additional capital invested by Javid, owner. When the owner invests additional capital into the business, it is called capital receipt. In the last video, I have given the examples of capital receipt. Examples of capital receipt. The first example, the sale proceed on sale of non-current asset. Second, bank loan taken. Third, owner invested further capital into the business. These are the examples of capital receipt. Here, additional capital invested by Javid is a capital receipt. So I am putting capital receipt tick mark. Bank interest received. Bank interest received. Received means it is a revenue receipt. It's a recurring receipt. So this bank interest received is a revenue receipt. Similarly, discount allowed, it will be treated as a revenue expenditure. So discount allowed is a revenue expenditure. Discount received is a revenue receipt. So discount received is a revenue receipt. Installation cost of new machine. So installation cost when new machine is purchased, it's a capital expenditure. Already I told you in the previous one. Installation is a capital. Installation cost of new machine is a capital expenditure. Now interest on bank loan. Interest on bank loan, that is a revenue expenditure. So interest on bank loan is a revenue expenditure. Then maintenance contract on new machine. Maintenance expenditure is also a revenue expenditure. So maintenance revenue expenditure. Next one, new bank loan taken. When a bank loan is taken, it is a capital receipt. Just now I told you. So bank loan taken, new bank loan is a capital receipt. Payment by tenant of rent. Payment by tenant of rent. That means rent is received from tenant. It's a revenue receipt. So payment of by tenant of rent is revenue receipt. Next, last and final, purchase of goods for resale. When we purchase the goods, it's a revenue expenditure because it's not an asset. It's the goods purchased for resale. It's a revenue expenditure. That's it. So all the items I have taken the tick mark. Example, additional capital invested, capital receipt. Bank interest received is a revenue receipt. Discount allowed is a revenue expenditure. Discount received is revenue receipt. Installation cost of a new machine is a capital expenditure. Then interest on bank loan is a revenue expenditure. Maintenance contract on new machine is a revenue expenditure. New bank loan taken, this is the capital receipt. Payment by tenant of rent, it's a revenue receipt. And last one, purchase of goods for resale, it's a revenue expenditure. So in this video, I have completed 7 main problems on capital and revenue expenditure. Inshallah, the next problem we'll take up in the next video.